Good there. Good. Hey, Natasha, you're right on time.
Hi, Bob.
Let me get my game face on. Okay. No, I'm ready. All right, we'll wait a moment or two. Christine should join us, and maybe Patty and a couple of the regulars.
Cool.
Yeah, chapter 14 is not exactly an easy one, but it's not the hardest either. Let's understand that adjusting entry for the inventory. And there's a part of the chapter we're not even supposed to teach, and you will not get it on the test.
Oh, goody.
How did your homework go after last night's session?
Oh, not good. I'm going to come see you later to finish that one problem.
Okay.
I couldn't do it.
The same one we were working on, where we came up with the right gross income.
No, that was from a different chapter. It was a LIFO, FIFO, and then the weighted average, and we kind of dismissed it. And then I went into it thinking I could do it, and I think it's because they have the problem worded differently, and I'm not getting how it's worded because the dates are moved around, and I think you'll see it and you'll be like, oh, this is how to do it. But it seems like for the most part, spreadsheets are a good tool to use at this point, would you say?
What when teaching, you mean?
Well, for the homework and these things, because they're getting pretty big.
No, absolutely.
Yeah.
So it's now 12:02. Do you know where your children?
That's Roll. They can find it on YouTube.
Yep. That's how the news in New York City began every night on one of the channels.
Oh, yeah.
It's 10 o'clock in New York City. Do you know where your children are?
Oh,
Jesus, no, I don't. They thought they were right here.
10 o'clock, too late. Come home.
Yes. Have you ever been to New York?
I have, and I'm going in October.
Oh, you're going in October too, huh?
Very excited. Yes.
Where are you going, and where are you staying when you go to New York?
I have a brother in Brooklyn.
Woo, boy, those Brooklyn Nets won a big game last night, huh?
Did they?
They did. What part of Brooklyn does he live in? Do you know?
Oh, I wouldn't know. He says I ask him those questions, and he says, "What would you know? You don't know Brooklyn." I'm like, okay, you're right.
Well, that's kind of how you learn, though. What part? He might live in. As long as he doesn't live in Brownsville or some of the real bad areas. But Brooklyn kind of went to hell when the Dodgers moved out of there in 1957 and got bad. And now it's really bounced back nicely. Hi, Patty. How we doing?
Doing good.
All right. We were just waiting to see if anyone else would join us, and you did. And let's get the show on the road. I said, let's get the show on the road. Now, I must share. Okay. This chapter has a little bit of repetitiveness to it, but it brings in some new things as well that we need to tie into it. All right. Adjustments for a merchandise business. And let me get comfortable here. Adjustments for a merchandising business. We have a special adjustment we make when we're using the perpetual system, okay? We have a preparing adjustment for merchandise using the periodic inventory system. We'll get to the perpetual one in a second. Review of, and bear with me, review of entries for purchase and sale of merchandise. Well, I think we know this. We're back in your famous periodic again. We debit purchases, we credit accounts payable, we debit accounts receivable, or cash, huh? Worksheet for a merchandising business, similar to a service business, and we use it to prepare the year-end adjustments. And it includes an adjustment to properly record the amount of the merchandise inventory held at the end of the period, used to prepare financial statements. So here we go. Andy's Auto Parts has a beginning merchandise inventory of 25,000. At the end of the accounting period, a physical inventory of the merchandise determined that it was now 27. And why is there more at the end? Well, pretty obvious. Purchases exceeded sales. We bought more than we sold. That seems pretty obvious to all of us. So what we have to do now is get rid of the old and get out with the old and in with the new. So we have a situation where the beginning inventory was 25 and the ending was 27. The merchandise inventory account is not changed during the accounting period. And remember, in the periodic, it's always the same because we're not crediting the merchandise when we make a sale. The cost of merchandise sold is not recorded. After a year of purchasing and selling merchandise, the merchandise inventory balance is wrong. So these last three slides have been a very, very, very long-winded way of saying this. We have to do an entry this way now. Out with the old, in with the new. You've heard that expression, right, Patty? Out with the old, in with the new. That's what we're going to do now. Out with the old. Step one, out with the old. We're going to take the beginning inventory and zero it out on our worksheet. And we're going to debit the income summary. Remember the income summary from a couple chapters ago when we were closing out the P&L? Income summary. We're going to debit income summary. We're going to credit merchandise inventory on your worksheet. That's out with the old. In with the new is the $27,000 of inventory that we now have after we went out there and counted. So now we got to go in with the new. The in with the new, we're going to debit the inventory and credit the income summary. And they're making a note here I think is helpful. Note that the debit and credit columns made to the income summary are extended into the adjusted trial balance columns. This is done because the individual amounts are needed for the calculation of cost of goods sold on the income statement. And you'll see that in a moment here. So we bring the income summary just over to the adjusted trial balance, and that'll be as far as we need to go. Oh, come on now. This thing doesn't want to change slides. Might have to do it this way. Okay. So we did the out with the old, in with the new, okay? Step 3 to 5, process address issues related to customers returning inventory. Now, this is the part that we are not really supposed to teach. You're not going to get this on the test. These anticipated returns. We don't think many companies do this, and I'm not so sure we really want to go over it. But what we're going to do is just take you through a real brief. They have to anticipate these losses. They have to anticipate that customers will return some goods. They have to anticipate it. So Andy estimates that 4,000 in refunds are coming back next year. They have to actually record that in this year because the refunds that come back next year are from this year's sales. So they expect to have a cost of 3,000. So what we're going to have to do here is we have a balance of 2,600 before any adjustment, and we want to get it up to the desired 3,000. And so that's what they're doing here, 2,600, and afterwards they get it up to, well, it's supposed to be 4,000. I am not going to go into the anticipating of sales returns or refunds. Estimated returns inventory. We're not going over that. I'm going to triple check with Cornelia, okay, guys? And if she says that that needs to be included, I'll have it for us on Friday. I'll make sure we get that into Friday's class, okay? And we'll go over it in necessary detail. So the estimated returns, again, we're not worried. Whenever you see the word estimated, don't worry about it, okay? Calculations of cost of goods sold. Okay, here we go. Now they're showing us part of the worksheet. So let's take a look, one, at the out with the old, in with the new. You see what balance we had? We had $23,000 there, right? Out with the old, we credit it, right? We credit 23,000 to get rid of it, and we debit income summary for 23,000. Okay? In with the new. The new is the 27,000. You're going to debit the new final merchandise inventory that was physically counted for 27,000, and you're going to credit the income summary. All right. That seem okay to you, Patty? Out with the old, in with the new. What do you think, Nastasia? Is that a little confusing yet? Out with the old, in with the new. What was the balance at the end of the year? $23,000, right? We know it's now 27,000. So the first thing we do is have to get rid of the old, out with the old. Credit that for 23,000. Now the balance is zero, right? In the inventory account, it was 23, now it's zero. The offset is income summary. In with the new. The new number is 27,000. Credit income summary for 27. And look what happens when we bring it over. Our $27,000 is sitting right there. So just do this a couple times. It's not that tough. Out with the old, in with the new. And they're looking at our end of period worksheet, okay? Notice they brought the income summary over because you might need that when you're preparing the statements. So look down here, Nastasia and Patty. Remove beginning inventory. That's what we did with this entry. Remove beginning inventory. Enter the, hold on. Oh, this thing is starting to annoy me. Losing the slide for some reason. Okay, well, let's just look at it, what we have. Enter the, get rid of the old and in with the new. All right. That's the main lesson of most of this chapter, understanding that transaction. Okay, now we have a new adjusting entry. And remember, I told you all adjusting journal entries are a search for missing expenses. I lied because here is an exception, okay? Unearned revenue, unearned revenue. Money received in advance before performing a service. Money received in advance before delivering a product or performing a service. That's actually a liability to the company. Can you believe that? You got money in the mail and now you have a liability? So let's talk about that. Monies you receive in advance are a liability on the balance sheet because the company owes the customer the product or service. And we're talking service. Hi, Christine. Welcome aboard. We were just going through, we're just getting to a new adjusting entry for us, Christine, called
Okay,
unearned
thank you.
revenue, just starting.
Thank you.
Now, what is unearned revenue? This is where you just got in here, Christine. Monies received in advance before performing a service. I'm going to stick with a service. And that becomes a liability. Let me give you my favorite example. You know, I'm a big sports fan, right? I sent in $25,000 to the Dodgers for season tickets this year, right? I sent that money to them in January. Well, when they got my 25,000 season ticket money, they don't play any baseball in the winter. They don't start playing games until when? April. So only when the season begins and they start playing baseball can they record that cash as income. So when they received the money from me, they debited cash and credited a liability account called unearned revenue. And then the season is 6 months long. So at the end of April, they're able to claim 1/6 of that 24,000, whatever number I said, as regular ticket income. They would get rid of the liability, debit the liability, credit the income. And let's go over that in a little bit of detail because this is new. Here we go. Brown County Playhouse sells season tickets, okay? And the tickets cost $10 each, and they put on 5 different plays. So there's a maximum of 1,000 seats that could be sold. They have a 1,000 seat theater in this nice small town somewhere in Pennsylvania. So 1,000 seats, and they're going to do $10 a seat. So you get $10,000 each show, right? Times 5 is 50,000. They are getting this money before they even put on the first performance. So when they get that money, they debit cash and they credit unearned ticket revenue. Unearned revenue is a liability account. Unearned revenue is a liability account. It's a liability account, not because we owe money to anybody, but in this case here, we own theatrical performances, okay? Now let's look at the adjustment. The adjustment. Following production of the 3rd show, it's time to close the month. So they did 3 shows. We agree? That's what they're telling us. They did 3 shows. Each show was sold out. 3,000 tickets times $10. $30,000 in earned revenue is removed from the liability account called unearned revenue and paid into the normal revenue account. The remaining balance of 20,000 is still a liability. So there is our journal entry, okay? Let me go back up one more slide. Here, we record the unearned revenue. As soon as we got $50,000 for next year's theater plays, we have a liability of 50,000. We owe $50,000 worth of acting. And what did they do here? They did 30,000 worth. Your adjusting journal entry is this: a debit to unearned ticket revenue or unearned revenue and a credit to regular ticket revenue. Make sense, Christine? Okay. All right, we'll keep going. It's a little tricky. It's new. And they're just showing you the T accounts as they like to do. Well, let's see here. We got cash of $50,000 and we debited cash and we credited unearned ticket revenue, which is a liability. Unearned revenue is a liability. Unearned revenue is a liability. And then they did $30,000 worth of business. Well, that means they've earned $30,000 worth of revenues. Now it's revenue. It's real money. It's real income. So you debit the $30,000 for the 3 plays and credit revenue. And now you've put it on the income statement. Okay. Let me see here. And here they're just showing you different accounts we've just been learning here. So look what we have here. Okay. What you missed earlier, Christine, I think I'm going to go over it again anyway, because it doesn't take long and it's important, is we learned that we have a different type of merchandise inventory entry to make at the end of the month, an adjusting entry. Estimated returns and customer refunds payable, that will not be on the test, okay? We as a faculty decided we're not going to teach that. We think it's a pretty obscure thing, not done very much. I went over it a little bit, but I'll as I said earlier in this lesson, I'll check with Cornelia and make sure, okay? If I need to really go over it in any kind of detail, I will. So basically with the estimated returns inventories, customers have to guess they have to guess at the end of the month how much they're gonna have coming through. And that's what that's all about. And the same thing with the customer refunds. And now what they're showing you here is revenue accounts. We know this, sales returns, subscription revenue. That's a good one to put in, huh? That's a classic unearned revenue. I subscribe to a number of magazines. Okay, I subscribe to Sports Illustrated. I send them a check in the mail for $52 at the beginning of the year. They get that money, they debit cash, they credit unearned subscription revenue. And then every week, they take $1 of that and move it over to the income statement, okay? Purchase returns and allowances, purchase discount, freight in. These are things we already know. And I don't know why they, oh, I see what they, those are revenues, unearned revenues there. Okay. It's small. Okay, let's look at the worksheet. Let's look at the worksheet, huh? Prepare the trial balance, prepare the adjustments, prepare the adjusted trial balance, do the income statement and the balance sheet. That's exactly what we've been doing. Now let's look at the little bit of tiny twist here, I think, okay? Here they're giving you, let me just look where they're taking us with this. Here they're giving you some adjusting journal entries. Some of these we're already familiar with, so let's take a look at it. Okay, you notice the first one, Christine, is A and B. You got two different entries. This is what you missed. A physical count showed that the merchandise inventory costing $45,600 is on hand. So we know that the on-hand inventory at year end is $45,600. All right. We have to now make an entry that I call out with the old, in with the new, out with the old, in with the new. We have to credit the current balance in the inventory to get rid of it. Let's see here. Okay. Look at the inventory account here, everybody. We credit the inventory. The 52,000 is the beginning inventory. That's what was sitting there when we closed it, when we got to the end of the year. So we're gonna out with the old, which A is out with the old, 52,000. And what are we going to debit? We're gonna debit our friend called income summary. Remember that over here? We're gonna debit income summary for 52. So that's the out with the old. They told us that the new balance is $45,600 in with the new. Debit merchandise inventory for the new and credit income summary for the new. Okay? It's a two-pronged report. Make a little more sense, Nastasia?
Yeah, it does. Thank you.
There you go. Went over it a couple times. Make some sense, Christine? Out with the old, in with the new. And there's a reason why you have to do it in two steps. And that reason is we need to bring both the old and the new inventory. Another way to, let me say it more clearly. We have to bring the beginning inventory, the 52 over, and the ending inventory over to the appropriate column when we get there. Okay. Let me escape. Okay. The second one is this estimated stuff. I'm not going to do anything to just tell you what the entry is. They expect to have 2,100 in returned next year, and there's 3,000 in this sales. They're just going to make an adjustment for the difference to get the right balance there. I don't even want to go into that. I also don't think I want to go into the supplies remaining at the end of the year. You remember those journal entries, huh? Supplies remaining at the end of the year were 800. The unexpired insurance at the end of the year was 400. You remember the supplies. We had supplies at the end of the year of 800. That means that we used 5,200. Remember that from chapters 5? We debited supplies. I'm sorry, we credited supplies for the 52 and we debit supplies expense. They said we had $400 left of unexpired insurance. We got to get rid of that. We credit 2,400 and debit insurance expense. And depreciation expense is always a debit to depreciation expense and a credit to the accumulated depreciation. So with these entries here, A and B is a very important one to learn. C, D, and E is a bunch of baloney. Let's not worry about that right now. You should remember from early in the book, chapter 4 and 5, the adjusting entries. I know Natasha knows these right off the top of her head right away. Huh?
Absolutely.
Yeah, supplies is the asset. We're going to credit. We're going to reduce the asset with a credit and put it into the expense. And they're giving you the depreciation numbers. And then here is our favorite, the accrual. Wages earned but not paid. That's wages expense, right? That's wages expense. Wages expense. Yeah, wages expense. Wages, oh, they put it up on top. Wages expense 700 right here. And you credit an account called accrued wages payable. Okay, that represents work that was done but not paid by the end of the month. And then I think we've got one more. We got one more entry. Now let's concentrate on K, okay? Let's say Sunflower Cycle publishes a cycling magazine. That must be good reading, huh? And subscribers pay in advance, and the unearned revenues at the end of the year were $1,000, okay? All right, let's take a look at this again. They publish a magazine and the subscribers pay in advance, and unearned subscriptions revenue at the end of the 31st is $1,000, okay? So let's see what they're talking about with that. They're saying at the end of the month, 1,000. Let me go back up here. This is poorly written. Let me read it again. Sunflower Cycle publishes a cycle magazine. Subscribers pay in advance. This really should say, I think, earned subscription revenue. Earned. They're not saying that's the balance, I don't think, but let's see. So we go to unearned revenue. That was the balance. Okay. So they're telling you at the end of the month, the amount that should remain in the unearned revenue account is 1,000. What do? We debit the liability for 2,000 and we credit subscription revenue. I really don't like the way that question was worded, because typically they don't tell you, they don't talk in that kind of language. They don't say the balance at the end of the month should be 1,000. Normally, when you're talking unearned revenue, you're talking about how much that was earned during the month, and you go with that. So they turn that into a little bit of a math trick there, I think. So we went through these entries here. Nothing there too terribly demanding, I don't think. Knowing you don't have to do anything about CDE. Okay. Uh-oh, I lost it. Come here, you. Here's our spreadsheet. Here's our spreadsheet. You see the adjusted trial balance? Remember they said they brought the income summary numbers over? Well, they had to do that for two reasons. They had to do it in order to keep the adjustments equal with all the information. And then over here, you need the beginning balance here, and you need the ending balance. I'm sorry, you need the ending balance here and the beginning over here. This is just what we looked at in terms of the worksheet. So let's take a look at it. Merchandise inventory, 52,000 to begin. Out with the old, 52. In with the new. In essence, we made a $7,600 entry. That's all. and we bring it over here. That's our new balance. We're not worried about the estimated returns and things like that. And then down here, they've got your adjusting entries. Your adjusting entries. Look at your liability accounts. Unearned subscription revenue was 3. Instead of telling you the 2 was earned, they told you that 1 was the ending balance. So we debit that for 2000 and we credit subscription revenue for 2000. And here are the other journal entries, the adjusting entries. We know that's a debit to wage expense, supplies, insurance, depreciation. Does anybody have any questions on any of these adjusting entries right now? Okay, we'll go. You know, when you start doing it, it'll be a little tricky, I predict. But out with the old, in with the new, and whoosh, you're in pretty good shape, I think. Okay. Out with the old, in with the new. Now let's see what else we got here. Journalizing adjusting entries. Here they're just showing you the journal entries. They put the horse. They put the cart before the horse the way they're laying this chapter out. But here we go. Here's the out with the old, Natasha. You debit income summary, you credit merchandise inventory. After that entry, the balance of inventory is 0. We took it out. So now we say, okay, the real balance is 45,600. That's what we counted. So whammo, you debit in with the new. Debit merchandise inventory, credit income summary. And then you had this information CDE on the revenue returns. We're not worried about that yet in this chapter. I don't think we're going to talk about that at all in terms of the test. And then these are the journal entries we reviewed like crazy on your first test. Supplies expense, insurance expense, the depreciations, the accrual. Review these again, because I know if I was running this test, I would deliberately pick a couple of them out because they're so important to understand. You know, the unearned revenue one is going to be on the test, right? You know that. You know that. And you know it's always going to be a debit to the liability and a credit to subscription revenue. And you also know to an empirical certainty that the out with the old, in with the new thought is going to be on the test. You know, it might be simple as a true or false question. True or false question. They'll say something like the inventory was 52,000 at the beginning, and then we counted 45,600. So therefore, credit the inventory for the difference of 7,400. No, you don't do that. You have to do the out with the old, in with the new. Out with the old. By the way, my Asian students, they don't pick up on that out with the old, in with the new stuff at all. It's funny. It's one American idiom that seems to give them trouble. Prepare adjusting journal entries under the perpetual inventory system. Okay, now we're talking perpetual. The merchandise inventory under the perpetual system, the merchandise inventory, estimated returns, cost of goods sold, customer refunds payable are continually updated throughout the year. Okay, throughout the year. And on this, let's take a peek. Let's take a peek. This is kind of a repeat of what we did on Monday, right? Look at this. On the periodic system, you're using the word purchases. Under the perpetual system, we're changing it to merchandise inventory. Purchases is a cost. Inventory is an asset. So under the periodic system, we know everything's going to be a purchase. The sales journal entry is the same for both methods. The key difference, though, is under the perpetual system, you're tracking the inventory all the time and recording the cost of goods sold with every single sale. So here we had a sale of 400 and the cost of goods sold was 300. So that expense, cost of goods sold, needs to be recorded now, not wait until the end of the year like we do under the periodic. So you debit cost of goods sold, you credit the merchandise inventory, okay? Because that's what we sold. We sold them our inventory. We returned goods to a supplier. Well, the entry is a little bit different here. The accounts payable, we got purchase returns. There are no such things as purchase returns under the perpetual system. How could there be? Because we're not using the word purchases. We're using inventory. So where you have purchases, the offset's going to be merchandise inventory, okay? Where you have purchase returns and allowances, it's going to be merchandise inventory. Customer returns stuff sold for a refund. Okay. The refund, the actual crediting of the sale is okay. Both of them debit sales, returns, and allowances because you never debit sales and you credit accounts receivable. But again, under the perpetual system, you are saying to yourself, well, I know that this is worth $40. So we're putting the $40 back in our inventory. It's a product that wasn't even open, so we can sell it again. $40 debit, credit cost of goods sold. So we don't take that loss. And here is sales returns. Let me just look at this. This is the estimated returns. We're not going to worry about this one. What they're saying is customers returned goods for a refund of 60. The cost was 48. So you're going to have a similar entry here, sales returns and allowances, credit AR. But here they estimated a number in advance, and now they're using up that payable. The customer returns is similar to unearned revenue. Again, I don't want to do anything except not confuse you with that. All right. Adjustments for expected sales returns and allowances. Don't worry about it. That's what we're just talking about. Okay, shrinkage. You ever hear of shrinkage? Christine, you ever watch Jerry Seinfeld?
I have.
You know what I'm talking about, the shrinkage, right?
Oh, yeah.
You know Patty and Natasha?
Mm-mm.
Yeah, well,
Oh, boy.
they're too young for that. They're too young
Yeah.
for that. Anyway, they had a funny story about shrinkage. Anyway, adjustments for inventory shrinkage. Differences are recorded in an account called short and over. What's shrinkage? Your inventory disappeared for some reason. In other words, you went out and you might count every day what we called cycle counts. I haven't talked about cycle counts. Companies that only take the inventory at the end of the year often have what are called cycle counts, where you go out every day and you count a few items. Typically, you divide your inventory up into A, B, and C items. A are the costly ones, and they make up maybe 70% of your value, and the B's would be 20%, and the C's would be the little stuff. And every day, someone from the accounting department would be chased down into the factory, and they would count 3 or 4 items, come back upstairs, compare them to the perpetual balance. If the balance was okay, there was nothing to do. We verified the inventory. But sometimes you're going to have a difference, and it's an unexplainable difference. And that has to be put into a cost of goods sold account called short and over. Cost of goods sold, inventory short or over. So they're saying here, a physical inventory shows 3,710 worth of merchandise, but the inventory has a balance of 3,840. In other words, you went downstairs during the month on January 8th or whatever, and you found that this item was 130 short. What you did before you recorded this entry, though, is you checked the transactions. You went to see if you can find a reason for this difference. What happened? We don't know. Maybe somebody stole something. We just don't know. But we have to recognize that the inventory has decreased by $130, and the inventory went down. So we have the short expense going up and merchandise inventory going down. So that one's not too bad. It's similar to the cost of goods sold, lower of cost or market. Okay. And that is this entire chapter. We're going nowhere near this appendix, okay? So this one, I got to admit, this one's kind of dull, no? What do you think? I don't think this is the most exciting stuff we did. But you got questions, Nastasia? Anything that was particularly onerous?
I think I'll find out later
Okay, yeah, that's one way to find out when you start. When you
when I
try
get
to
into
do-
it.
Yeah. Patty, it looked like you were catching up with me pretty good all class. What do you think?
Yeah, I'm pretty good. I I have like a question mark next to one segment in my notes, and I don't remember what the actual question I was gonna ask was.
Oh, you choked, huh?
Yeah, I think it has to do with with unearned revenue. It was something involved with like the thing that I think I understand it now, so maybe at the time when I was taking the notes, I
Okay.
was confused. But right
Okay,
now,
yeah,
I'm
the
good.
unearned revenue, just money you receive in advance. You cannot
Yeah.
put that on your income statement as a sale because you
Yeah.
haven't earned it yet. Only when you earn it can you put it as a sale, and it will be a sale in the month where you actually played baseball or
Yeah.
performed the play or mailed the subscription. Question, Christine, anything?
Well, I do have a question, but it's in as respects to chapter 13.
Go for it. That's all right.
Is that all right? It's one of the questions on the quiz. Can I share my screen?
Yep. Hold on.
Bob, if we have time, can we go over that one that I couldn't do either on 13 if there's time?
Yeah, of course.
If you guys want to see.
Yeah.
You
think
should
it
be
was
able
the
to share
homework.
now, Christine.
Okay. Here, let's see. Okay. Share screen. Can you see? Wait, can you see my screen?
No, not
No.
yet.
I have gold. Hold on.
Well, maybe I need to stop sharing.
Yeah.
Hold on. Now I see everybody in big, bold pictures.
Okay, let's see.
Jesus, I lost a lot of hair, huh? My goodness.
Can you see it yet?
Yes.
Okay, let's see. So let's go over here. I'll just go, I gotta go to my get in here. 13 quiz.
Uh-oh, the quiz.
Yeah, okay. So number 9.
Mhm.
I'm like,
Holy
was.
cow, look at this, huh?
these are confusing to me, but
Okay. Well, they're giving you the template to get you going, so that's a big
Right.
head start, okay?
yeah.
So of the 1,600 units sold, 300 were from the beginning inventory, 500 from the first purchase, 600. So they're telling you exactly where they came from, okay?
Right.
Which is good if you're using the specific ID method, okay?
Uh-huh.
But then it says using first in,
First
first
in.
out costing,
Mhm.
value the inventory at the end of the period.
And I thought it was the 300. Wait, what do I have? Spend like a
Remember,
bit.
if I can interrupt real quick.
Yeah. Go ahead.
Remember I said sometimes it's easier to start with the lower number instead of working with the 1,600 was sold.
Right.
You
With
know,
the
maybe it's
500.
easier to work the 500, okay?
Right.
So
Okay.
under FIFO, you know, those 500 have to be from the third layer, the third purchase. So 500 times 5.5 would be the value of the
Oh, yeah,
inventory.
that's right. Yeah, because it's okay. See, so I did that. Wait, is that what I did?
That should give you
500.
2750, right?
Yeah, see, and I did that one and it was wrong.
Well, so
Thank you, Patty.
the instructions I think are probably just wrong because it says, so it says first in, first out, but it gives us the specific ID form of saying, okay, 500 from, 300 from the beginning inventory, 500 from the first purchase, 600 of the 700 from 200 from the second purchase are used, and then 200 from the third purchase are used. So
Oh.
So that,
So
yeah,
it's not first in, first out based on the instructions, even though it says first in, first out.
Yeah.
Yeah, it's, see, I thought they were doing that deliberately to trick you. They're giving you all the specific ID, but then they're telling you they wanted FIFO. No, so when you multiplied it out like that, you got the right answer, huh, Patty?
I haven't done this yet. I'm just.
Well, let's do it
assuming
real
that
quick,
If,
okay?
if doing first in, first out is wrong, then it probably is
Right.
going the other way.
Yeah, you're gonna have to quickly multiply 300 times 5.10.
It is
Plus-
2750. That is the answer.
Yeah, what'd you
Yeah.
get?
2750, and that's what I put,
there's
and it
So
two-
was
you get
wrong.
2750 either way.
I
No,
don't know
no.
how I got the answer. I did second and third, so that
All
must
right.
be
Okay.
LIFO.
Let's quickly do it. 300 times 5.1 is how much? That's 1500.
1530,
What's 500 times 520?
2600.
What's, oh, wait a minute, hold on. Okay, they sold 300, 500, then 600 times 5.3.
Sorry, I have the full
It's 3180.
And then 200 times 5.5.
200 times 5.5 is 1100.
Yeah, add those up. So that was 300 times 5.10, 500 times 5.2, 600
It's
times 5.
8410.
Is that one of your answers?
Yeah.
I can't see the 8410. It's hidden.
It is. Oh no, I'm sorry. It's not. It's 8390.
Yeah,
There
so
you go. Boy, that was, hey, Patty, that was a pretty good clue, huh? When they suddenly throw in $8,000.
yeah.
But that
then
was the,
it's-
now hold on. What we
but
just
that's
did
wrong,
was
though.
not right.
wrong.
Was, okay, no, it's wrong. So you came up with what, 80 what?
8410. Let
We
me
just-
re-add it.
We just violated my rule, which said start with the easy number. What is the, I turned this into a problem that's much harder. Let's start from the, real quick. The 300 and the 500 are gone, right?
Right.
So we only have 100 left in the second
Of that
purchase.
other one.
So that would
Okay.
be $530. And they sold, how many then they sold 200. So you have 400 times 5.5. Add those two numbers up. If there's a God in heaven, that's the answer.
Okay, let's try that.
The first two layers are gone. The 300 and the 500 are gone. The second
Okay, so
purchase
that's
is you got 2 times
530.
5.3.
400 times
Oh, so
2200. 3,
I
7.
think the right answer. is
2730.
Yeah,
Yeah,
that's got to be the right answer. Yeah, you got screwed on that question. That's all.
Yeah, I was like, oh, I'm gonna.
So
Cool.
I just want to tell you guys, I did that one, and I got 2750, and it was correct. Maybe I'm wrong on my part, but I got
No.
2750.
No, yours was not wrong because you might have been given different numbers. Not all the numbers.
You
are
think
the
so?
same.
Oh Lord. Well, okay.
Pretty
Yeah,
sure.
All
I
right.
might,
Oh, wait a minute.
Crazy.
Wait, what answer did you say? It was
2750.
that. It's probably right then, because you know what? Mine was 2570 that was wrong.
So
So
you just got the wrong one because of the number switch.
I did. Okay.
oh
And
my
I think
goodness,
that's-
So
2750
it is first in,
minus.
first out. So it's actually was the correct instructions, and they were messing with you.
You
So
guys.
Cornelia,
the
are you
bottom
listening?
line is 2750.
Yeah.
Okay.
Yes.
Okay. So
It's the one that gives you the green dot. That's how we know it's right.
No, that's for the homework. This is for the quiz.
Okay.
The quiz
yeah. So
2750.
Okay.
Bottom
I'm
line.
gonna.
I was
I'm
working
gonna-
under the assumption that 2750 had been marked wrong when you turned
Right
it in.
now, and I'm sorry, that would be my fault.
Nothing but trouble, huh?
I have
Yeah.
another question on the quiz. The one that
Go
I
right ahead.
kept getting wrong, which was really silly, but Bob, don't make fun of me. But
Which one?
it was when merchandise is sold.
What
in the-
problem? What?
Well, it was number 4. It was number 4. I don't know if Christine, if
Now
you
you-
have it
Yep,
too.
I have it right here.
I couldn't get it right, so if you wanted to tell me the answer, that'd be great.
This is number 13,
Debiting
Number-
accounts receivable and crediting sales.
and the journal entry for sale would include a debit to when you sold
Accounts
something. When a merchandise sold, and you debit accounts receivable. That looks right to me. Hold on.
This one's right because I took the test
Okay.
once. No.
All right.
Oh, now hold on a
I-
second. When merchandise is sold and the journal entry for sale would include. Actually, two of those entries should be right. Yeah, you are going to debit accounts receivable and credit sales, but you're also debiting cost of goods sold, but you're not.
Yeah, see, that's the one I kept doing because of the cost of goods, but there was really nothing in the book that helped on that.
I found,
that I
you know
know.
what? I did find something on that. I'll
Go
tell
for
you
it.
where it is. Let me find it. Because that's how okay, let me see if it's this one. Yeah. What system is this? The perpetual, right? Look
Yeah.
on page 491.
Hmm.
On 491, it gives you like the different ways to enter it. So,
Hmm.
right, it says like the transaction periodic system and perpetual system, and it gives you like what it would be. So I found it right on that.
Awesome. I'll take a look.
Okay, I don't have to share my screen now.
Okay.
How do I get out of it?
Stop
your
share,
Zoom.
be
There
up
it
on
is.
top. I can kick you out if I need to.
Okay. Did I get out?
Go to your Zoom and then you can unshare.
Okay, I just kicked you out then. Did you want to show something, Nastasia?
Yeah, I do.
Okay, you
You guys
should
will
be
get
able
a
to do that. I gave you that power.
Oh, cute.
You
We
have
still have
that-
Christine's. Christine,
Oh,
go
you
to your
do?
Zoom. Go to
Oh,
your
who's a cute
Zoom.
girl? Who's that?
That's Lily. That's my
That's her
daughter.
How old is
Aw.
Lily?
She is 16, almost 17.
Wow.
That was
Aw.
younger. She was about 10 then, I think.
Look at Lily. Hi, Lily.
She
she-
keeps saying hi when she walks by, and I had her on mute. So
I was
Thank you.
telling Nastasia that my 6-year-old niece was joining this class last semester
really,
for about 25 minutes once a week. Her
wow. So just think, when she gets to be of age, she'll know how to do everything.
No, what happened was her father thinks that if she exposed her to me teaching the big kids, it would inspire her.
That's
And
great.
she would sit here and the
Good.
students and I would clown around with her. And then father would say, time for bed, Annabella.
Aw,
Say, good night, everybody. All right, go ahead.
That's
What you
cute.
got here?
Christine, you gotta, I think you need to
oh,
unshare yours.
how do I? Oh,
So go to your Zoom at the bottom.
I think I
Oh.
did it. Did I stop?
Okay, I think you just did. Yes.
Sorry.
You're fine. And then Bob, I think you still need to.
I believe so. Let me. Oh, here we go. Now you got it. I'm sorry, I did not.
Okie dokie.
Okay, now you're good.
I hope this helps everybody. Because I've been
Every
bashing my head.
discussion helps.
Sure.
Been bashing my head against the wall for the past.
Oh,
hour.
Holy
these
cow,
ones
look
are
at the size of
hard.
this one.
Okay, so we're back to the same kind of the situation. So FIFO, LIFO, and weighted average.
Mhm.
Did anyone do this yet?
I haven't done the homework yet.
Calculate the total amount to be assigned to cost of goods sold and the ending inventory under each. Now, FIFO, you should have got correct, no?
Can we do it together, please?
Yeah.
Is that okay? Want to
Yeah.
work on it? Okay, I got the time, not a problem.
Okay.
I would like to know what the ending inventory, there's 1,300 left in the ending inventory, okay? Now, let me give you all a tip. What is the total available cost? They're giving it to you.
The 95.6.
Yes. Now, 1,300 is a low number compared to 4,000, okay? So why don't we do the cost of the ending inventory and not worry about the cost of goods sold? So under FIFO, which ones would still be there, Nastasia? We have 13,
The bottom ones.
the 700, right? And how much on the, and then say it to me as follows, 700 times.
Uh-oh. So, okay, so this is what I wrote, and maybe this will make sense to someone. So 300, so, well, I got 8390. So 300, 500, 700, and 100. Does that make sense to anybody?
Yeah, you're working with the cost of goods sold. So you did that correctly, but you must have made a math error. What I'm suggesting here is let's do the ending inventory because it's much easier.
Okay.
So your ending inventory, there are 1,300. Under FIFO, you have the 700 still there, right?
So I got doing this. I got for ending inventory 34,100.
And you got it by multiplying 700 times 27.
And then 200 times 26, and then 400 times 25.
Okay, that sounds right. You see what we're doing, Nastasia?
So 700, I'm sorry. One more time, 700 times 27. Okay, I get it. 200 times 26.
Yep.
Yeah.
And then we need 400 more.
Yeah, because you have
1,300
units remaining, so you just go up from the bottom, and yeah.
Okay, cool.
So try that number.
Yeah, for the ending inventory, just put in like the 34,100.
34,100.
Now let's see if that's right. Because if it
Woohoo,
is,
good job.
now you can do the cost of goods sold in 2 seconds.
Just minus this, the 95 from the 95.
Yes, exactly. Or keep up with that relationship. Yes.
Okay.
Come on, you can do that one in your head, right?
Oh, no. 61,500. What did you
There
guys
you
get?
go.
Yep.
You got it?
Cool. So
Do LIFO. What's left under LIFO? Last in, first out. Under LIFO, we got the old stuff still, right?
so we start from the top.
Yeah.
Yes.
But we're basing this number, so we're basically trying to get all these units until we hit 1,300, and that's when we stop.
Exactly.
Yeah.
And then
Exactly.
once we get that number, we will have the cost of ending inventory, and
Right.
then from that I take it off the total.
Right. Right.
Okay.
You can compute the cost of goods sold first or the ending inventory. So here we got 4 and 9, 4 and 5 is 9 and 2 is, yeah. So the only one you really have to, 400 times 20 is 8, 500. I'll let you guys do the arithmetic. You like LIFO, FIFO? It's kind of fun, no?
It's been tricky. I think I get the concept, but maybe when I get this calculator out, I just crumble. Okay, so 400 times 20 is 8,000. 500 times 20, 50. Tell me if this is annoying, people. 1250. And then
It's not annoying us, but you have those first 3 numbers right there. You just copy them down.
what numbers?
The 8,000, the 10,250 that you just calculated.
Oh, uh-huh. Oh,
So that gets you up to 11,000. That gets you up to 1,100, right?
First 3 costs, and then you need another 200 from the.
6,900.
Yeah,
No.
basically you need 2/3.
Not 6,900, but you're only using 200.
Yeah, so
Be 200 times 23.
you could just take 8,000 plus 10,250 plus 4,300 plus 4,600.
Wow. Okay. Do you happen to have that, Patty?
No, I mean,
Okay,
I
let me
said
do
those
it.
numbers, but that was not what
No,
the
it's all
calculator-
good. Okay, so 8,000.
Let me try to do it in my head. 46, 49. That's 11,150. 11,150.
22.
19,150. What'd you get?
22,850.
Okay, well, I did it in my head.
2250.
22,850.
Check it out.
Oh,
No,
Ah.
you'll have
It's just-
27,150.
27,150. Oh, okay, I did do that one more.
Cha-ching.
Okay, now put
Okay.
your cost of sales number in. Yeah, this is a good exercise to go through. See, this is the kind of thing we could do if we were in the classroom more, you know?
Mhm.
I could be, running around the room and doing my act.
Good job, everyone.
68,
Now,
450.
weighted average, that's the super easy one. Don't disappoint me on this one.
Oh
So
God, divide this one. We're dividing here.
divide it out.
And-
Tell me what you get.
And then I have to multiply something.
Yeah. So 9,500 divided by
Okay.
4,000 is what?
Oh, whoa. Oh,
95,
95,
6 divided by.
About $18 and something.
23.9.
Okay. How many units are in the ending inventory?
1,300.
Go for it.
31070.
There you go.
This one?
Yeah, that's the ending inventory, right? How many did we sell? We sold 2,700, 2,700 times that number. But okay, you can do it that way too.
Wait,
95,600 minus.
95.
Minus
Oh,
64,530.
okay. Good job.
Not too hard when you start doing it, huh?
Mm,
Now here, you just got to do a little bit of arithmetic for specific ID. The only way you can do this is just multiply each one of those by whatever it is. 100, let's see. So in the ending, they're doing the ending inventory. Okay, so they're telling you. You have 100 in the October 18th layer, 200, you got to multiply those out. You want to take a second to do that, guys?
Yeah, scroll up so I can see the full.
sure. Multiply by what? The
Well,
unit price?
Yeah, by the
Of
correct
course.
price for each
Yeah.
one.
yeah.
So,
So
mhm.
October 18th, find your October 18th layer. You see it? Yeah. So 100 times 2050.
Oh, I feel like I've done this problem. Oh, so 8410. I think that's that.
Then you go 200 from the January 12th.
23.
That's your 4,600 we did earlier.
Darn it.
So we're knocking out a bit of your homework, huh?
Yes, and thank
Maybe
you,
students will
everyone.
see that I help you with the homework and they'll start coming to class.
Class is fun.
Yeah, fun. Of course it is. Fun, fun, fun. Specific ID and weighted average are the two super easy ones when you think about it. But you know how they tried to foul you up in the prior publisher? Instead of giving it to you very clearly like this, they would say, of the units sold, 2/3 of the first sale came from 1/5 of the second layer.
Oh God.
Oh, that's just mean.
It was mean. That's a good word for it.
So can you explain again the specific ID? So I'm just we're looking at the
Okay.
the units.
Right. Specific ID
Here.
means that these are actually the ones they sold. We're mimicking, these are the cars from Perry Lincoln. They have
Yeah.
to track them exactly. So Perry Lincoln had 100 left in the inventory, left in from the October 18 layer, 100 times 20.5. They had 200 left from to 12th, 200 times 23. And you do that, you do those 6 multiplications and then add them down. Anybody finish the arithmetic?
Almost. Oops, I did, but.
Oh, yeah.
I didn't do it because I know my answer will be wrong.
Nah, you'll be fine.
I'm sorry. No, it's so bad. Bob and I spent.
I saw your
a long
answer.
time
Put it
trying to
in. I saw your answer there. You had like 31,250, something like that. I saw it.
I've been
Um,
writing the same number over and over again. for
I
this
have
for
32,400 and it came out right
Oh,
on
Yeah.
the ending inventory.
That's what I got.
And then the
Nice.
cost of goods sold, I just take that number and subtract it from the 95.6.
Yep. Give you 63,100, right?
63,200.
Like I said, 200.
There we go. Yeah.
Good job, you guys.
Right on.
Did
So
you
you're
guys
pretty
get the
good with that,
answers?
Nastasia? You should be.
Well, I'm hoping that's just not on the test, and maybe I can worry about it for accounting
Yeah.
230.
Okay.
Yeah.
Okay.
I think I'm
key-
just going to put this to bed.
The key thing to remember is once you have the cost of goods sold, you automatically have the ending inventory.
So work on cost of goods sold always.
Once you have the ending inventory, you already have the cost of goods sold.
So you could just do the ending inventory and then it'll be easy to get the cost of goods
Yeah.
sold.
Now,
when
if
you're
they were,
talking
if they,
about
were-
the-
if they were, Nastasia, if they were asking for just the cost of goods sold, the calculations would have been totally different, right?
Right.
You would have to go do the cost of goods sold side, but maybe even then, if this problem said just do the cost of goods sold, doing the ending inventory would still been the best way to attack it because it was a much smaller number to work with.
And so which numbers were those though? And was it these? No, wait, ending inventory.
It's
So
all,
this is
Well,
this.
That's your 1,300 ending inventory.
That's what we were working off.
Yeah.
We didn't
Yeah.
really work off this besides just getting the numbers, right?
Right. Now, if we were talking cost of goods sold under, say, FIFO, you sold the old stuff first under FIFO. So you sold 400 times 20. You sold 500 times 20.5. You sold 200 times 2150. And now you only need 200 at the next level. 200 times that is 4,600, and that'll add up to 61.5. If you want to do it, you got a calculator there, Nastasia, real quick?
No, I ended up throwing it away.
Open it up.
Yeah,
Open up.
I have it. It's here.
Just open it. Just go back to the very top so I can see the very top.
Okay.
All you have to do is add 8,000
Okay.
plus 10,250
Okay.
plus 4,300
Okay.
plus 4,600.
Right. Okay.
Add that up and that should match your cost of sales number.
Okay, cool. Yeah, Patty that was something that you were explaining, Patty. Okay. All right. Awesome.
Okay?
Thank
Anybody
you.
else? Anybody else got anything?
that
Good.
totally helped me too. Thank you, Natasha.
Yeah, hopefully I saved you guys some hours.
You did.
I was just like, no.
Yeah, maybe it's too late for this class, but maybe we should work in a little problem like this at the end every time,
That'd be
I
cool.
like that.
Yeah.
Yeah.
Super helpful.
All right,
does.
Nastasia, Nastasia gets extra credit and so does all
Everyone
you guys.
does. Everybody does.
Actually,
Thank
none of you guys get nothing, but you get the idea.
Yeah.
We got some answers for homework, so we can move on to something else.
Excellent. All right, well, maybe see some of you tonight, huh?
Yeah.
Not
I'll
me
probably be
though.
here.
Oh, actually,
Hey.
probably yes. Next
Okay.
chapter.
Hey,
Maybe.
take
Thanks,
care,
Bob.
everybody. Bye-bye.
Bye.
Bye.
Have a good one.